Hi there, we're Group 18 and today we'll be presenting about our project on stablecoin. Firstly, I'll be introducing about stablecoin and talk about the dual class structure we adopted to design stablecoin, followed by the method and result about pricing of stablecoin. Then Yuhan will be further analyzing on it, mainly focusing on how the jump rates, AB ratio, and resized bonds will impact the pricing. Lastly, Johnny will show you how we further design the stablecoin based on the stablecoin that's mentioned in section 2. From the creation of Bitcoin in 2009, more than 2,000 cryptocurrencies have been traded in exchanges. In contrast to the huge numbers of cryptocurrencies, very few people use cryptocurrencies for normal day-to-day transactions today. Even for those companies that do accept cryptocurrency payments today, like Microsoft and Spotify, who allow customers to pay in Bitcoin, none of these companies keep their money in cryptocurrencies. Instead, they immediately convert the cryptocurrencies they received into USD, as they don't want to expose to the market risk of volatile cryptocurrencies like Bitcoin. Thus, in order for cryptocurrencies to become more useful than just a speculation tool of investors, there is a severe need to build a stable store of value. Stablecoin is defined as a cryptocurrency that aims to maintain a stable value relative to a specified asset or index. So existing stablecoins like Tether, USD Coin, and MakerDAI aim to serve as a means of settlement of automated financial products. They also offer the possibility of so-called smart contract, meaning self-executing code, and possibilities for programmable money. This could bring a range of benefits, particularly in the context of cross-border transfers. Inspired by the dual-purpose funds, our project aimed to design a dual-class structure pegged to ETH, with a fixed-income stablecoin, Class A coins, and also provide leverage investment opportunities to Class B coin holders. In other words, the holder of coin B borrows money from coin A holders and pay coin A holders a fixed interest rate. Next, I'll be talking about some main characteristics of our dual-class structure. ETH will be considered as the underlying cryptocurrency of our project, which means the Class A and B coins can be created by depositing ETH into the custodian smart contract. So we'll be setting the ratio between the Class A coin and Class B coin to 1.1, in other words, alpha equal to 1. Which means upon receiving 1 plus alpha shares of ETH at time t, the custodian contract will return to the depositor alpha beta P0 units of Class A coins and beta T P0 units of Class B coins, where here the P0 is equal to the price of ETH at inception of coins, and beta T is the time t conversion factor, which will set the beta 0 to 1. At each reset time, the beta T will be reset according to the ETH price PT at the time. The initial net asset value of coin A and coin B, which we denote as VA and VB0 at inception time, will be 1. Since the Class A coin behaves like a bond, the coin A holders will receive periodical coupon payments. In our stable coin, we will set the daily coupon rate as 0.02. In the design of the product, we ensure that no arbitrage is allowed in the market where the smart contract rules will be applied. Since the price of ETH will fluctuate, thus to ensure there's no arbitrage, the following parity relation must hold at all time. For easier reference, the relative price ST is introduced. When alpha is equal to 1, the sum of the coin A and B's net asset value shall equal to 2 times of the relative price. Next, we move on to different types of resets in our product. So the first one is the regular reset. The regular coupons will be paid every 100 days if no other resets happen. Within the period, the holder of each Class A coin will receive R times T dollar, and the net asset value of Class A coins and Class B coins will be reset to $1. The holder of each Class B coin will have no cash flow at the reset time. As there should have no market arbitrage, the conversion factor will experience a jump at the regular reset time. It can be deduced as this equation. Next, we'll be looking at the upset reset. The upset reset ensures a minimum leverage ratio of Class B to ensure the Class B coin attractive to investors. When ETH price goes too high, the net asset value of B will be increased a lot, thus lead to a low leverage ratio. The coin B becomes less attractive. So in our design dual-class structure, the upset reset will happen when the ETH price doubles from the ETH price from the last reset. At the reset time, the net asset value of both coins will be reset to $1. The Class A and B holders will receive the payment of value VAT minus 1 and VBT minus 1 respectively for each coin A and coin B they hold. And the conversion factor, beta t, will be reset to pt over p0 so that the parity relation holds. We denote the upside reset criteria as HU, and HU is not dependent on the time t. Next, we will also have the downside reset. The downside resets reduce the default risk of Class B to protect the Class A holders when the ETH price goes down. The net asset value of Class B goes down. So in order to ensure the holder of Class B coins still able to pay the coupon to holders of Class A coins, the reset will happen. When VPT reaches the predetermined lower bound of 0.25, the Class A holders will receive a payment with dollar value VAT minus HD per coin A. There's no cash flow for coin B holders. And at that time, 1 over VPT shares of Class A and Class B coins are merged into 1 share of Class A and Class B respectively, so that the net asset value of both classes reset to $1. The conversion factor beta t is reset to pt over p0 and the st will be reset to 1. As the relationship between the VPT and st is known, the criteria can be represented as when the st is smaller or equal to the HDT, which is dependent on the time t. In our design structure, the 0.25 will be the value of this letter-like symbol, HD. With the understanding of the characteristics of the dual class structures, we now can price the stablecoin A. As mentioned earlier, there should be no arbitrage in the market. It also implies that the market price of the Class A and Class B coins shall satisfy the parity relation we mentioned earlier. So by applying the standard option pricing theory, we can get the following market price of A, which is the expectation of WA in different scenarios. Here the R is the risk-free rate calculated based on the average 10-year US note treasury rate over the calculation period. Then the tau and eta is the first upside and downside reset time from T. Then the 3 lines on the right of this equation represents the cases of regular resets, upside resets, and the downside resets, respectively. At regular reset time capital T, the holder will get a coupon payment R capital T and a new Class A coin with the T reset to 0 and ICE is reduced by this shown amount. At the upside reset time tau, the holders will get coupon payment R tau and a new Class A coin with T reset to 0 and value reset to 1. At the downside reset time eta, the holders get a coupon rate R eta and also can withdraw the value of 1 minus the absolute value of VB, as the VB might goes below 0. And the VB shares of new Class A coin will be reset to the value of 1. To solve this, we made assumption. The ETH price P shall be following a geometric Brownian motion under the risk-adjusted measure. With this assumption, the P will be continuous, thus the VB will be equal to HD on the downside reset, so that we can simplify this previous equation by substituting VB with HD. Based on the new equation, we can deduce the partial differential equation of WA on T and S. Within a period, the WA shall satisfy the following PDE, and the boundary conditions here are referring to the different scenarios we just mentioned. The first one is the terminal condition with T equals to the capital T, which refers to the regular reset case. The second one is the upper boundary and refers to the upside reset. The last one is the lower boundary and refers to the downside reset. Thus, with the PDE, we can use the iterative method to obtain WA and WB. Firstly, we can obtain the hourly ETH price in the predefined period, then calculate the reset timestamp and consider the data between the 2 adjacent reset timestamps as one period. Thus, the reset event will only happen at the last hour of the period. Secondly, for each of the period, we use the lattice method to construct the finite difference grids. Started with the initial guess of WA at time 0 is a series of 0. Each runtime of the finite difference method will provide a better estimation of WA at time 0. The process continues until the difference between the returned WA and the previous WA is smaller than the tolerance we set. Then we get a good estimation of WA at time 0. Then with the explicit method, we'll be able to get WAT for every point on the grid. Lastly, since the value of S is known for every time point, using the interpolation method, we can get the simulated market value of Class A coins. Then the Class B coins market value can also be obtained from the parity relation. This is the simulated market value of Class A coin from 13th of October 2017 7 a.m. to 23rd of December 2020 12 p.m. We can see that the market value of Class A coins is within the range of 1.02 to 1.065, and there were 17 reset events happened in this period, which segregated the whole period into 18 pieces. As highlighted with the reset bands, the market value of Class A coins drops when there is a reset event. The annualized return volatility of Class A coin is 4.124%, which can be considered as stable when comparing to annualized return volatility of the well-known stablecoin, Tether USD, which is 7.242%. This is the simulated market value of Class B coin for the same period. Compared to the Class A coins, the Class B coins are more volatile due to its leveraged natures, as the annualized return volatility is 43.398%. Next, I'll hand it over to Yuhan for more analysis.
In this part, we conduct analysis in terms of jump risk, reset bounds, and AB ratio and WA and WB, namely the market price of Class A coin and Class B coin. Jump risk occurs when a sudden jump in ETH price results in the net asset value of B, denoted by VB, lower than the downside reset bound or even negative, which is not included in the assumption of geometric Brownian motion. We first evaluate the inherited jump risk in our data by replacing the downside reset bound with VB. The result shows that values of both WA and WB remain almost the same after our modification, with WA slightly lower and WB slightly higher. This graph shows the result of WA, and this one is for WB. The possible explanation is that in our hourly data, all VB is positive and not far away from the downside reset bound 0.25. To be specific, the lowest VB is 0.171. We further explored the impact in the case of negative VB, which is beyond our data. Hence, we used Monte Carlo simulation and jump diffusion model with constant intensity 0.2 per 2,400 hours and constant jump size minus 80%. We find that for the simulation part where an 80% price drop does occur, VB can be as low as minus 0.63, and the value of WA at time 0 decreases to 0.38. When such an extreme price drop does not appear in the simulation path, the value of WA at time 0 is above 1 and is close to the value of the one computed from model without jump risk. Then it comes to reset bound analysis. To evaluate the impact of upside reset bound and the value of WA and WB, we change the bound from WETH price to 2.5 times ETH price and compare it with the original bound. By doing this, the new stablecoin contract is more tolerant for low leverage. Based on our data, there are fewer upside and downside resets under the new bound. Apparently, high reset bound reduce the number of upward resets. As for downside reset, this is because beta becomes larger after upward reset, as is more likely to be smaller, given a stable net asset value of Class A coin. The net asset value of Class B coin is easier to reach the downside reset band. Thus, frequent upward reset may be followed by a series of downward resets. We then have a look at the pattern of WA. It is high in the case of 2.5 times ETH price and most of the time. Exceptions occur due to different upside or downside reset dates. For example, stablecoin with the bound of 2.5 times ETH price triggers an upside reset on 19th December 2017, while the original stablecoin completed this reset a week ago. After 16th May 2019, the gap between these two WAs widened, for the orange line only has regular payouts since then, while its counterparty has several upward or downward resets at the same period. Overall, the size of the difference between the two WAs is small, indicating that value of Class A coin is relatively stable. As for WB, before this time point, WB under both reset bounds are almost the same for most of the time. After 16th May 2019, WB based on a reset bound of 2.5 times ETH price is an apparently higher value for most of the period. The reason is similar to what we discussed for the latter period of WA. To evaluate the impact of downside reset bound, we change the bound from net asset value of coin B lower than 0.25 to lower than 0.2 and compare it with the original bound. By doing this, the new stablecoin contract has more tolerance for high leverage and default risk. This can also be observed from our result. Leverages and downward reset dates reach 6 to 9 when the band is lower, which is higher than leverages of 5 to 7 under the original bound. Regarding WA, the two Class A coins behave similar, with WA slightly higher most of the time if the 0.2 bound is applied. Overall, the value of Class A coin is relatively stable in both cases. But mind that exceptions do occur due to different reset dates. As for WB, at the beginning and end of the period, WB are almost the same under both reset bounds for most pairs of observations. Since stablecoins in these two scenarios have same types of reset on the same days during this time, the difference between two lines fluctuates in the middle, again due to the different schedules of reset. AB ratio, denoted by alpha, is the proportion of the amount of Class A coin to the amount of Class B coin. Alpha has a direct impact on the leverage taken. A small alpha indicates fewer Class A coin relative to Class B coin, hence low initial leverage. To analyze how AB ratio affects the values of WA and WB, we choose alpha equals to 0.5 and 2 respectively, then compare results with the one that assumes alpha equals to 1. Based on the given data, if alpha equals to 0.5, 1, 2 respectively, corresponding leverages and downside reset dates are 3 to 4, 5 to 7, and 9 to 19, which is in line with what we mentioned in the previous slide. Besides, downward reset happens more frequently as alpha increases. The reason is that leverage grows with the increment of alpha, leading to smaller net asset values of Class B coin under the same amount of ETH price drop. In general, the values of WA become smaller as the AB ratio increases. Minor exceptions occur occasionally due to different reset dates. Moreover, research shows that smaller AB ratio contributes to larger adjustments of WA values on reset dates. In other words, WA is more volatile if Class B coin has more weight. Since WB is derived from the sum of 1 and alpha times S minus alpha times WA, we first have a look at these two parts. Alpha times WA are stable and center around 0.53 1.04 to 0.05 if alpha equals 0.5, 1, and 2 respectively. For values of the sum of 1 and alpha times s, as the graph illustrates, they increase as alpha increases. The combination effect of these two parts yields the patterns of B. The results reveal that in our data, the values of WB are more volatile if alpha is not equal to 1.
Thanks, Yuhan. Recall that in the construction of a Class A, the coupon rate is usually higher than the risk-free rate. Then at the downward reset time, a portion of Class A coin will be liquidated. Then the holder of Class A will lose high coupons that will be generated. Thus, we are motivated to design a new stablecoin based on Class A, which uses the risk-free rate R as a coupon rate R prime. We denote the coins by A prime and B prime. In the contract, the split structure resembles that for A and B. Class B prime borrows money from A prime to invest in Class A, and 1 plus alpha A can be split into alpha A prime and 1 B prime at any time. Conversely, the same amount can be merged into Class A. A prime and B prime reset when and only when A resets, and A prime receives the coupon at R and B receives at this rate. So the net asset value of A prime is this equation, and they hold the parity at any time. The changes to them are shown in the table. As we mentioned before, at each reset time, A prime and B prime receive payment at the 2 rate, and the net asset values all change to 1. In particular, at the downward reset time, because Class A gets the principal payback, so both of the new coins get the liquidity value. Now we look at the pricing method. The framework is similar to Class A, but the difference is that A prime uses R prime as a coupon rate, and the third term indicates that upon downward reset time eta, if VB is positive, Class A prime receives coupon rate and this liquidation value, and if VB is negative, A prime receives its full net asset value and may take a loss by receiving this amount. Following the assumption same in Class A, VB can be replaced by HD, so the term can be reduced to this term. Therefore, the value of A prime satisfies the following PDE. The change compared to A is R prime and the liquidation value on downward reset date. Using the same parameters as A, the value of A prime is shown here. You can see the results are very stable during the whole time period with a value close to 1. If we detrend the value by Class A prime by its net asset value, it has an annualized standard deviation of 0.011, which is smaller than that of Class A. Even without detrending, Class A prime has an annualized return volatility of 0.0095, which is much smaller than that of Tether and the 3-month Treasury rate. If different to Class A prime gets coupon payment at the risk-free rate R. Therefore, at downward reset time, there's no portion of a Class A prime will be liquidated, and the holder of a Class A prime will not lose coupons. However, the loss of Class A coins leads to the downward drop of A prime values, and due to the leverage influence, the declines are reduced. Thus, the value of A prime is more stable. To sum up, first, inspired by the dual-purpose funds, we designed a dual-class structures that offers entitlement to fixed income, stablecoin A, and leverage investment opportunities, stablecoin B, which pad to the ETH prices. With application of the option pricing theory, we get the market price of the two classes of coins. We have shown that the proposed stablecoin A has a lower volatility than the existing stablecoin Tether. Then we analyze the impact of jump risk, reset bond, and AB ratio on the values of A and B. For jump risk inherited in the given data, the result shows that the value of both A and B remain almost the same after our modification, with A slightly lower and B slightly higher. In the case of extreme jump risk simulated by Monte Carlo simulation and jump diffusion model, the value of 0.1 decreases to 0.38 when extreme price jump of 80% appears in the simulation path. As for the reset bond analysis, in the case of upside reset bond, A is higher in the case of a higher bond at most of the time. B under both reset bonds are almost the same before this date. Since then, B based on a higher bond has an apparently higher value for most of the period. In the case of downside reset bond, the two class A coins behave similar, with A slightly higher at most of the time if the bond is lower. The two class B coins are nearly the same, with B based on the lower bond slightly lower than its counterparty. In terms of AB ratio denoted by alpha, the result shows that the values of A become smaller as alpha increases, and smaller alpha contributes to larger adjustments of A values on reset dates, and values of B are more volatile if alpha deviates from 1. At last, we designed the class A prime and B prime coin based on the class A. The split structure between them resembles that for class A and B. By using the risk-free rate R as a coupon rate for class A prime, it behaves like a money market account. The results show that the value of A prime is more stable, is a more reliable means to store value. That's the main content of Group 18's project on stablecoin. Thanks for your attention.